Right now, the U.S. is facing a crisis that could decimate the stock market by 70% or more. Eventually, it will obliterate retirement accounts and blow a $142 trillion hole in the global bond market. In short, I am talking about the financial equivalent of a nuclear event that would lay waste to business as usual here at home and upend the global economic order as we know it. Now, today I want to show you how this is likely to play out, and more importantly, what I believe you should do to protect yourself. Now, this crisis has been decades in the making. America's spending, as we all know, is out of control. As I record this, our national debt is more than $37 trillion, and it's not hard to figure out why. Uncle Sam has spent more money than he has taken in every single year for the past 2 decades. In 2024, that deficit, the difference between what they bring in and what they spend, was more than $1.8 trillion. It has gotten so bad that we are now spending more money on interest payments than we are on national defense, and it is entirely unsustainable. By 2035, the interest on our debt will exceed total income tax revenue. That means 100% of the taxes that you pay on your income will go toward interest on money they've already spent. And that figure comes from the U.S. Congressional Budget Office. But these estimates are notoriously low. The government almost always takes in less money than they project and spends much more. So in reality, if federal spending and revenues continue at their current rates, the national debt will surpass $46.5 trillion by 2029. That would put the debt-to-GDP ratio north of 140% before the end of the decade, more than triple the historical average. The bottom line is that the federal government is on the brink of financial ruin, and the world is taking notice. The value of the U.S. dollar fell 10% in just the first 6 months of 2025, and the wealthiest investors are already positioning their portfolios. Because the reality is, we could reach the point of no return much, much sooner than you probably think. I'm talking about the point where we can no longer afford our interest payments, and America finally defaults on its debt. So what happens then? Well, we don't have to speculate. This scenario has played out time and time again throughout history. When Russia defaulted on its debt in 1998, its financial markets collapsed. By the time the stock market closed on August 13th, it had plummeted 65%. The Russian currency was devalued by 75% in a matter of weeks, and inflation soared to 30% month over month. In 2001, Argentina defaulted on $85 billion in sovereign debt. The aftermath was the worst economic and financial crisis in the country's history. The currency depreciated by more than 66% in a matter of weeks. Unemployment shot to 25%, and more than half of the population was pushed into poverty. Greece is probably the ugliest example of what can happen to a developed nation when it falls into extreme debt, and it wasn't very long ago, 10 years. In 2015, the Greek government officially defaulted, and the country was economically shattered. Unemployment topped 27%. Homelessness rates soared 264%. Extreme poverty reached 17% of the population. Suicide rates rose by 35%. Now, I know what you're thinking. You're thinking, okay, Ross, don't scare me. That's other countries. That would never happen in America, right? Well, not only can this happen, it has happened before. In fact, if it weren't for a debt default, America may never have become the global superpower it is today. In 1783, the Treaty of Paris officially brought the Revolutionary War to an end. America, yes, we won our independence, but it came at a very steep cost. Just like today, the government was deeply in debt. Just like today, there were only 2 viable options on the table: print more money or take out more loans to pay back the debts already owed. Now, the U.S. had already taken extreme measures to finance the war. We'd taken huge loans from France and the Netherlands. We'd issued more and more continentals, which is the paper money used by the colonies at the time. Now, I doubt most of you realize we've been printing money as far back as the Revolution. And I'm sure I don't need to tell you what happens to a currency when it is printed into oblivion. By the end of the war in 1783, those paper continentals were worthless. By 1785, the situation was so bad that we stopped making interest payments to France. The economy was in chaos, the currency in ruins. And so the Continental Congress bit the bullet and stopped payments on the national debt. In their view, it was the only way out, but it was only one part of their plan. The second part, of course, was to create a new currency to replace the Continentals that had been completely devalued. And on July 6th, 1785, the U.S. dollar became our official currency. But even that was not the paper dollar we know today, because back then, the money you carried in your pocket was actually worth something. Those early American coins were made of solid gold and silver. Even when we started printing paper money again, which is in 1861 to finance the Civil War, those bills were backed by solid gold. In fact, we were still minting gold coins all the way up until 1933. And it wasn't until the worst president in history, Richard Nixon, ended the gold standard in 1971 that America moved to a fiat currency backed by nothing but the, quote, full faith and credit of the United States government. And it doesn't take an Ivy League degree to figure out that when a currency is completely untethered from anything of actual value, when it is literally just a piece of paper, you can keep printing as much as you want. But make no mistake, there are consequences for all of that printing. For 54 years, the federal government has had a license to print money thanks to our fiat currency system, and the results have been catastrophic. It should come as no surprise. Every fiat currency in history has failed. It is only a matter of time. In post-World War I Germany, massive money printing led to hyperinflation that saw consumer prices double every 3.7 days on average. In Hungary, after World War II, inflation reached the highest levels ever recorded. To try and keep up, the government printed bills worth 100 quintillion. That is 100 followed by 18 zeros. You might recall when the Zimbabwe government printed so much money in the mid-2000s, it spiked inflation to the equivalent of 98% day to day. Don't believe me? Here's what one of their $100 trillion Zimbabwean notes look like. It happened in Venezuela in 2018, Yugoslavia in 94, China in 1949, Greece in 1944. I could keep going. History has proven that paper money backed by nothing but thin air is unnatural, it is illogical, and it is dangerous. Now, recently, some forward-thinking investors have actually taken the time to look at the numbers, to see the writing on the wall. And they began buying up physical assets after the COVID-fueled money printing era of the early 2020s. And this buying frenzy only made inflation worse. Real estate prices have surged as hedge funds and family offices have bought up hundreds of thousands of single-family homes, since rents, after all, will rise alongside the impending inflation. They bought Bitcoin and half a dozen other limited supply cryptocurrencies, and many of those have surged in price by thousands of percent. But what about the big players? What about the central banks, the foreign governments? They can't put trillions of dollars into Bitcoin and apartment buildings, even if they wanted to. So they are rapidly turning to another asset class, one that has been a safe haven for centuries. And I'm talking, of course, about gold. Gold has been prized as a store of value and a symbol of wealth for nearly 5,000 years. The first gold coins were minted by the Lydian Empire around 600 BC. Even Jesus Christ encountered gold coins in the Holy Land. Now, gold prices have been surging for months, and the world's richest investors have been backing the truck up. Steve Cohen, Joel Greenblatt, Ken Griffin, Larry Fink, Howard Marks, Jeremy Grantham. These are the best investors in the world, and they see the writing on the wall. They've been piling into gold assets, and for very good reason. Not only is gold one of the oldest, most enduring forms of money on the planet, it is considered one of the best safe haven assets for times of economic uncertainty. Even Warren Buffett, who has famously hated gold his entire career, has plowed more than $500 million into the gold miner Barrick Gold over the last few years. These people see what's coming. They believe, as I do, that gold will reach 10,000 an ounce and higher. Because you see, gold is not your typical financial asset. In the stock market, and you've seen me do this, we can catch a breakout move on a stock in a few weeks, maybe a couple of months. Gold is different, okay? When you look at the history of gold prices, you're going to see that it goes through these long periods of stagnation. Prices will stay flat for years, decades, and then when it finally breaks out, it unleashes these historic multi-year moves. You see, gold can trend upward for much longer than your regular stock. It can march higher and higher for years, and I like to call these periods super cycles. Here, take a look. In 1972, just a few months after Nixon boneheadedly ordered the end of the gold standard, we saw the first major super cycle begin. And between 1972 and 1975, gold soared from around $45 an ounce to nearly $200. That's a 340% move. It happened again in the mid-2000s. After spending a decade in the $300 to $500 range, gold soared to nearly $2,000 an ounce in just a few short years. Then, for more than a decade, 2011 to 2024, gold was again range-bound. It went nowhere. There was this ceiling of resistance that held the price below $2,100. But that all changed last year. Now, for the record, I am not playing Monday morning quarterback here. Okay? On April 13th, 2024, I sent all of my members, thousands of them, this email. I outlined exactly what we could expect to see. I even held an emergency live briefing about what I believed was an explosive opportunity to buy gold, and this is what's happened since. But the move is not over. And again, if history is any indication, this super cycle is just getting warmed up. Billionaire Pierre Lassonde, one of the most famous gold investors in the world, has argued that the yellow metal could reach 19,000 an ounce by 2027. Macroeconomic analyst Luke Groman has pointed to record levels of gold acquisition by central banks as a catalyst that could send prices to $20,000 during this super cycle. And Jim Rickards, the hedge fund manager, global currency expert, former CIA advisor, he's predicting gold reaches $27,000 based on a federal revaluation of the gold supply. In other words, what's really in Fort Knox. So historically, these super cycles lead to 300% to 400% increases in gold prices. But that's under normal conditions. That's without $37 trillion in debt and climbing. That's without countries ditching the dollar at a record pace. And it's without bond markets on the brink of complete collapse. Now, this is not some hyper-speculative prediction. What could be the greatest gold move in history is underway, and the smartest, most well-connected investors on the planet are loading up. Billionaire hedge fund manager Paul Tudor Jones, one of the best traders who's ever lived, said, quote, "As a macro trader, I think the best trade is going to be gold." Ray Dalio, billionaire founder of the world's largest hedge fund, is on record saying that if you don't own gold, quote, "you know neither history nor economics." And get this, just a few months before his appointment as Secretary of the Treasury, hedge fund manager Scott Bessent said, quote, "I think we are in a long-term bull market in gold. It is my biggest position." Now, call me crazy, but when the sitting U.S. Treasury Secretary, the chief financial officer of the federal government, is on record saying the biggest portion of his portfolio is allocated to gold, I think it's wise to have some gold exposure in my own portfolio. So all the conditions are in place. What I expect to see over the next few years is the biggest gold surge of all time. And investors today have a real opportunity to multiply their money many times over. Now, let me be clear in my conviction, because you guys know I don't pull punches. The U.S. is going to default on its debt. Not today, not tomorrow, but it's going to happen. It is not a matter of if, it is a matter of when. And the events of the last 6 months have made me more certain of this fact than ever. I mean, just look at what happened. Trump brought in Elon Musk, arguably one of the greatest businessmen of all time, to run a task force with the sole mission of eradicating government bloat, slashing the deficit, and getting our country's financial house in order. And for 5 months, he worked around the clock. He put his other businesses on the back burner, watched Tesla's market value plummet to focus on fixing the government's broken budget. And the result? In the final days of Elon's tenure with Doge, the House of Representatives approved a budget that raises the debt limit by $4 trillion while adding another $2.4 trillion to the deficit. Does that sound like a move away from default to you? But it's worse than that. You see, Musk and his Doge team set out to cut $2 trillion in government spending. But even Elon quickly realized that this was an impossible task. So I'll give you the numbers. This year, the government is on course to spend $7 trillion. It's hard to even say. Now, 60% of that budget, $4.2 trillion, is earmarked for Social Security, Medicare, Medicaid, and a host of what they call entitlement programs. So I don't like that name because it sounds like it's a handout. It's not. Now, these are not optional line items. These are mandated by law. Then there's the discretionary spending. This is where Doge was really focused. Now, projected discretionary spending for 2025 is $1.8 trillion. Doge, with great effort, identified just $160 billion in potential cuts, all while the government spending continued to go up. And let's not forget, interest on our debt is now the second biggest expense in the federal budget. And it's about to get much, much worse. You see, in January 2022, the government was borrowing money at 1.4% interest rates. And even at that rate, it spent $719 billion in interest payments. Well, 2 years later, in 2024, interest payments were over $1 trillion because rates have doubled to about 3.3%, which is still extremely low. So at our current pace, by 2029, the debt is projected to be more than $46.7 trillion. But again, that is assuming these rates stay what has been historically low. That investors will continue to buy our soon-to-be worthless bonds for a measly 3 to 4% return. Even under the best circumstances, with rates rising in tandem with ballooning debt, rates will be closer to 6% in the coming years, and that is wildly optimistic. Remember, interest rates on federal debt are determined by the market. As the government racks up more and more debt, investors will demand a higher premium for the higher risk they are taking on. And at a certain point, the risk outweighs the reward. And those investors start looking elsewhere. And it's already happening. And guess where a lot of these investors have been plowing their money? Central banks, as I said, are building up massive gold reserves. They are diversifying away from dollar-denominated assets. China, the second largest holder of U.S. debt, can't seem to get enough gold. As central banks and these large foreign investors buy less treasuries and demand higher rates on the bonds they do buy, the dollar continues to lose value. And we're right back where we started with two options in front of us. Take out more loans if we can find any creditors, or print more money. But listen, let's say I'm completely wrong. Let's say Congress lets this game continue without ever defaulting on its interest payments. Do you think Congress is going to rewrite the law to stop paying out Social Security? That politicians will put 69 million senior citizens at risk of homelessness? That is political suicide. They would never get reelected. What about Medicare? Losing those benefits would force many seniors to sell off their assets, to dip into their dwindling savings just to finance their health care. Then there's defense spending. In 2025, the budget allocates $1.9 trillion to the Department of Defense. Do you think that's going to go up or down in the years ahead? The only way for America to sustain its spending is for the Federal Reserve to crank up the money printer. And once all of our tax dollars are going toward interest payments, the impact is hard to even imagine. You thought 8% inflation was bad a few years ago? What do you think 40%, 50%, 60% or more would feel like? Remember Zimbabwe in the 2000s? A head of wilted lettuce cost $12 million. A loaf of bread went for $10 million, and that's if you could even find it for sale. America will be completely unrecognizable from what it is today. You've seen what happens when governments print money by the trillions and pretend there are no consequences. Prices rise, trust erodes, and capital begins to shift into places that offer real, tangible value. Gold is one of those places. It always has been. And as you've seen, the smart money is already piling in. So here's what I believe you're going to see. Gold will continue to rise on the trend it is now. My projection for gold is between $8,000 to $12,000 an ounce over the next 2 years. Beyond that, obviously, price is much higher. I don't say all this to scare you. I'm not saying to get out of stocks and the market's about to crash. This will happen slowly, but if you know that it is happening, you know what to look for, you can begin taking action to protect yourself. Now, as of today, I have 25% of my retirement dollars into gold and gold miners. I've got this split pretty evenly. I don't try to pick names. I tend to focus on ETFs in retirement accounts versus individual stocks. And so it's half in GLD, which is the gold ETF, and half in GDX, which is the gold miners. Mining stocks, when gold goes higher, tend to do even better because their profits rise faster than the price of gold. Okay, so if it costs you, $2,000 an ounce to get out of the ground, and you can sell it for $3,000 an ounce, your profit is $1,000, right? If the price of gold goes from $3,000 to $4,000, well, your profit doubles. Same $2,000 to get out of the ground, but now you can sell it for $4,000 instead of $3,000. So your $1,000 profit turned into $2,000 when gold went from $3,000 to $4,000. Does that make sense? So like when gold goes up 25%, the profits of this gold miner go up 100%. That's why you're seeing GDX and these gold miners up 100, 200, 300%, while gold's up 60, 80, 100. Okay, so I think you want to own some there. Now, I also believe in holding physical gold. I have, as of this week, begun buying physical gold and silver and plan to do so for the foreseeable future. There's several ways you can do this. The easiest is just to go online, one of these precious metals brokers like APMEX or one of the other reputable ones, and you can buy silver by the ounce, you can buy by the 100-ounce bar, you can buy gold by the 1/10 of an ounce or 1 ounce or 10 ounces. There are a lot of options available to you. I'm not going to pretend to be the expert on precious metals coins, but what I do is just stick to the household U.S. minted ones and then bullion in 1 ounce or 10 ounce or 100-ounce bars, depending on the metal you're buying from a reputable mint. Now, if you want to add silver to your retirement account or investment account, which is also in a meteoric run, you can also do that with ETFs. The silver ETF is SLV. This is backed by physical silver, and the price, it trades just like a stock, and it will rise and fall with the price of silver. If you want to buy silver miners, the ETF to do that is SIL. So one ticker, one trade, and you're going to own a basket of silver mining companies. I've also begun buying real estate, and this is one that, to some people is an option, to others it is not. I am building a commercial office building here where I live because rents, whether it's an office rent or an apartment rent, is going to rise with inflation. So it's an inflationary hedge that should rise in value, as we've seen with real estate prices over the last 5 years during that historic inflationary period. My expectation is over the next 5 to 10 years, as my thesis becomes reality, as the world begins waking up to this, I will begin to shift more and more dollars away from stocks and paper assets into physical assets like precious metals, like real estate, and the like. Now, none of this is official financial advice, okay? I have to throw a disclaimer out there. Consult your financial professional before making any major decisions. I am simply sharing my research, my 20 years of experience, and following the breadcrumbs to what, to me, is the only possible outcome of this scenario. My hope is that you will use this information to protect yourself. Now, if you haven't already, hit the subscribe button down there in the corner. That way these videos will show up in your feed, and I look forward to seeing you in the next video update.